Turning now to housing, and the plight of the first home buyer could be about to become a lot more difficult, and not just because prices are rising. The central bank wants banks to hold more cash in reserve for loans with small deposits because it's concerned that 30% of new loans are currently higher risk mortgages. For what that might mean, I'm joined by Gareth Vaughan from interest.co.nz. Morning, Gareth.
Morning.
So what is the rationale for wanting them to hold more cash when they're making loans like this?
Well, basically, at the moment, some of the big banks have got up to a quarter of their home loan books on these high LVR loans, which are of course, where the borrowers have less than 20% equity in their property. So the Reserve Bank is getting a bit concerned, and as you noted in your intro, 30% of new lending is coming on these high LVR loans. So the Reserve Bank is basically saying, look, if there's a major economic downturn, if house prices fall, then these homeowners could see their equity wiped out. So they're a bit concerned about the increased growth, and there's also been a recent warning from credit rating agency Fitch about these loans as well.
So if the Reserve Bank makes these changes, how is it going to change the bank's behaviour? Are they going to stop making loans like this because it makes up a lot of their business? No,
they won't stop. I mean, it could increase the cost for the banks of doing this type of lending, which I guess is potentially a disincentive for them to do it. But that said, I mean, the changes the Reserve Bank's proposing would not see these loans go back to where they were in 2008. Just to explain that, for the big four banks, the average risk weights on home loans at the moment are between 25 and 31%. Up to 2008, they were mandated at 50%. My understanding with these changes the Reserve Bank is proposing is they wouldn't go back as high as they were up to 2008. And you've also got to, I guess, take into account that a major factor for the banks is their own cost of funding. So the money they borrow to then on-lend to their customers, that's a major factor in how they price their lending. And then also the Reserve Bank did the same thing with the rural sector in 2011. They increased the risk weights on farm loans, and we've actually seen farm lending rise to a record level since then. So, I mean, in theory, it may be bad news for first home buyers, but it might not be.
Because if it was to make it more expensive, these are the people who are already struggling to get into a property market where prices are going to record highs, isn't it?
Yeah, absolutely. I mean that's the thing to watch closely, I guess. You're looking now with the median price in Auckland, for example, based on the last Real Estate Institute figures of $535,000. A 20% deposit on a house like that's $107,000. I mean the national median price, the 20% deposit for that is about $76,000. So you're talking a lot of money. So, I mean, if people are going to be required to have that size deposit, I mean, that's not going to be easy to get on the property ladder.
Well, that combined with what the Reserve Bank is proposing with actually restricting those high loan-to-value ratio loans, the first home buyer must be starting to feel like they're under attack.
Yeah, look, it's an interesting time, and I guess maybe some people are thinking, oh heck, I better go and buy my house now before these changes come in. But I guess at the end of the day,
you might see a rush into the market by first home buyers.
Well, you could do, but I mean, at the end of the day, I can't see the government just sitting back and seeing the first home buyer squeezed out of the so-called Kiwi dream of getting on the property ladder. So I wouldn't be too worried.
Thank you very much, Gareth. That is Gareth Vaughan from interest.co.nz.